Hello guys, welcome back to another Lumley trading video. In this one we're going to be doing our gauntlet recap, so our funding trading process, what's happening and how is it going. So annoyingly today we did actually lose $181, which again isn't too bad. We can easily make that back in a trade, so I'm not too worried about it. But what happened? How did we lose money? What was the trade execution? So here you can quickly see the trade execution. For us, it was only actually a 3-second trade, got in as soon as it turned 10 because this is when the ISM data was released, and we were out 3 seconds later. Now that exit was a manual one, and I'll kind of show you the reasons behind this and how we can kind of improve going forward. So the trade plan on this, and you can tell by the entry we got, was a directional play. We went through a lot of these last week. We know the yen doesn't fake out. We try and catch direction. How do we do this? We literally just use the ladder, and we will just place if we go into a sim, all we're looking to do is just place a sell stop limit that side. Would also look to do the same that side, and then as soon as the news comes out, it will either trigger one of these, and again, because we know there's not a fake out, we'll get the direction 9 times out of 10 correct, which is what happened. We got direction correct. So if we go on to what happened on the orders, we go to 10, you can see we did get the direction correct, it executed, but what happened? Why did we still lose money on this trade? So if we go into the actual, this is a tick by tick chart, so it can make direction a lot clearer, and we can kind of see how did it move. So now we're going over to 10 AM, and how did it move? The move happened super quick. So this is the second it turns 10. Obviously we're retail traders, we're not institutions. Our executions are always going to be a bit delayed, and they're always going to be slower than the obviously big money and kind of the people going with massive size, because the reason for that is obviously we're just trading retail. So our executions are always going to be lacking. We know that going into it, so it's how can we combat this? And this is one thing I am now going to have to kind of observe going forward, because what happened on this was this moved here within the second, well, under a second, it did this whole move. And so our trigger, as you can see by here, triggered our sell order, triggered all the way basically here. So then what happened was we saw it start to spike up, and basically I just cut out. Reason for that was obviously if I know we got filled down here and it pushes back up to break even, there's going to be a big loss on the table. So knowing that, I kind of just saw that, instantly kicked out, and that's why it was a 3-second trade, just as a way to manage risk. I could see the execution was too poor. It's better to get out now, because the way we trade the strategy is really a 1-minute trade. It's get in, get out, but considering it gapped so far, and that's where our entry was, there was no really upside to it, or not enough upside to kind of justify the risk we were taking on. So that's really why the trade plan kind of played out as it did, but why it was let down by the execution. Now this is one important thing to note, because we can see again this is tick by tick. You can't see this in the 1-minute chart, but what happened, and actually if we throw this into a say 5-second chart, actually it could make this a lot clearer. Let me see if there's a quick way to get back to 10 AM. There we go. So this is a 5-second chart. So again, this will kind of give us a much cleaner insight into how it moved as the data released. So data released, this is 5 seconds, popped all the way down. Annoyingly, we got a fill basically at the exact bottom of this candle, popped back up, and then this is where we closed out, because we all closed out within kind of the 3 seconds. Now we see it closed up. This is 10 seconds in, 15 seconds in, 25 seconds in, 25 seconds in, and then we would have been back into profit. But again, we have to manage risk. We saw it spike that much, and considering how quick it spiked back up, to me it was looking like it was going to be more of a fade to get out now, and then it kind of stopped that being a loss. In hindsight, obviously we could have just stayed in the trade, got out with a small profit, but again, we never know that when we're actually taking the trade. So it's all about just actively managing the trade and kind of dealing the cards we dealt with. Obviously the fill was bad, so we just had to deal with that and kind of counteract it the best way we could possible, which was kind of getting out the trade, waiting for the next one. Obviously we know we got multiple opportunities this week. We now have 3 more. We got the crude oil inventories, we got the natural gas on Thursday, and I think on Friday it's also, is it PCE? So we know we got more releases come up, so it's better to save the money really for that, save the potential drawdown just in case those trades go against us as well, then instead of kind of just letting this one kind of destroy us going forward. Whereas a $180 loss is easily manageable and can be made back, within 10 seconds on the next trade. So that was kind of the thought process between getting out. Now this is something I'm going to observe going forward. And now, because on Thinkorswim, obviously we don't have those 5-second charts. The smallest we have is 1 minute. So sometimes it can be hard going back to test how does this actually react more kind of quickly. Obviously we can check on the tick chart, but sometimes this happens so quick. You got to think this move was 3 seconds, so sometimes it's hard to see that on a tick chart. Sometimes that could be 20 seconds, sometimes that can be a minute, because obviously we don't get the second by second detail. So that's the only problem with trading it like this. And now we've got NinjaTrader, we may be able to go back and test these entries, which is all we can really do. See what the fault is, see if it's something we can improve on going forward. So what I'm really going to be testing is, if it's a directional play, how often does it do the downwards move, pop back up, and then continue direction? Basically, essentially a second wave. How often does this happen? Because if we know this happens regularly, what we can do is wait for the release, see that spike down, and then within a second or two hit the short, and then we can get a much better entry somewhere like here. And then we also actively know what our risk is going to be, because obviously that's the only risk you take with taking the trade with the order either side, is we have kind of the way it will trigger, but we can never be guaranteed kind of where our entry will be, which obviously here was pretty poor. So that's really going to be the key testing thing going forward, is how can we improve this? And this may be something, well, it will be something I'll be looking into, and hopefully this is something that we can better execute than going forward. If we see it pop down or play the direction, it quickly pulls back before going, because again, this wouldn't be unlikely to see, because again, a lot of algorithms are going to be triggering, a lot will be playing the news. So it's how can we get in, how can we use this to advantage? If this is a common pattern of it falling, pumping, and then crashing once again, then that's going to be an easier way to trade the trade. And then obviously we know what our max risk, or kind of can get a better idea of what our risk is going to be. One other thing we can look at going forward is kind of going more into the minute chart, and it's how does the second wave work? So second wave is basically does the move, comes back to retest it, and then moves once more. So we can see on the yen, this did actually not happen. We never got that second wave. It kind of did direction, kind of consolidated before breaking lower. What we ended up seeing though on the S&P was obviously it played direction for that kind of first minute, started to pull back just like it did on the yen, but this would pull back a lot quicker. And then once we hit into basically the pre-news level, it hit that level, kind of spiked, but then instantly started to fall. So if this is a common pattern as well, maybe this is either how we trade it or just how we can maybe get a second trade out of the news. If we see these second waves happen quite regularly, that's definitely a potential. And it can be maybe we don't even play the second wave, say on the S&P, that's where the second wave happened, but can it be something that we can trade going onto a different currency? Obviously if it feels or kind of does feels the move on the S&P, does it then provide a trading opportunity on the yen or a currency or a bond or anything like that? So these are just really things, it's just getting me thinking, obviously. And that's the great thing with kind of with these funding challenges is it's $100. If you lose it, it's $100, not really the end of the world. But the things you learn when you're kind of going through it as a, when there's money on the line, you just think about things a lot more critically. If you just do paper trading, no money on the line, even though this is essentially paper money, you still have a kind of a monetary risk associated with it, because obviously if you don't pass, you don't get the $50,000, or if you do pass, you do get the $50,000. So it makes you think a lot more about the trade, it makes you be more analytical. So that's why one of these things, even if we do end up failing this challenge, why I like doing it, and I will be doing them again, because they just increase your trading knowledge so much quicker, just because again you're doing more analysis on it because you have a reason to. And that's why I really don't like paper trading. That's why I don't paper trade all that much, because I think with paper trading you just don't learn all that much. But yeah, so that is kind of the breakdown. End of day summary, down 180. We have no trades coming into Tuesday, so I won't be trading that. Wednesday at 10:30 market time, we have the crude oil inventories. We will be trading that. That's just a fade. Thursday 10:30 as well, we have the natural gas fade. I will be looking to play that. I do have a charity event that night, so I don't know if I'll be at home to trade that, because obviously I'm over in England, so that is going to be 3:30. I don't know if I would have left the house by then, but if not, that will be the trade opportunity on Thursday, and then into Friday. I think it's called PCE, but whatever news releases out Friday, that is our last trade of the week. And then I think going into next week, there's not too much apart from the inventory releases. Anyway, I hope you enjoyed the breakdown. If you did, why not drop a like and subscribe, and I hope to see you next one. And that's it. Peace.